I'm Dhanlakshmi, working as an assistant professor in the Department of Corporate Secretaryship with the CA and Professional Accounting. Today, we are going to see something about a liquidity ratio. In management accounting, ratio is one of the very important tool which is used to express the relationship between two or more items of the financial statement. Simply, a ratio is a mathematical relationship between two items expressed in the quantitative form. Ratios are classified in several ways. In the various types, liquidity ratio are very important one. A liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligations. The metric helps determine if a company can use its current or liquid assets to cover its current liabilities. There are three types of liquidity ratios. First one is current ratio, second one is quick ratio, and third one is cash position ratio. In each of the liquidity ratio, the current liabilities amount is placed in the denominator of the equation and the liquid assets amount is placed in the numerator. Given the structure of the ratio with assets on the top and the liabilities on the bottom, ratios above 1 are sought after. A ratio of 1 means that a company can exactly pay off all its current liabilities with its current assets. A ratio of less than 1 would imply that a company is not able to satisfy its current liabilities. So again I say liquidity ratio is three types. First one is current ratio, second one is liquid ratio, and the third one is cash position ratio. Then the formula for the current ratio is current assets divided by current liabilities. First, we want to know the meaning of the current asset. Current assets are those assets which can be converted into cash within a period of 1 year. Assets that fall under current assets on a balance sheet. These are all the current assets. The list of current assets are cash in hand, cash in bank, debtors, stock, bills receivable, short-term investments, short-term loans and advances, prepaid expenses, income earned but not received. Next, the current liabilities are short-term financial obligations that are due either in 1 year or within the company's operating cycle. The list of current liabilities are sundry creditors, bills payable, outstanding expenses, bank overdraft, credit card debt, short-term loan, advance incomes, provision on our debtors, payroll tax collected but not deposited government account, income tax payable. Then the second ratio is liquid ratio. This is also known as quick ratio or acid test ratio. The formula for the quick ratio is liquid assets divided by current liabilities. Here the liquid assets means current assets minus stock and prepaid expenses. Then the third ratio is cash position ratio. The formula for the cash position ratio is cash plus bank plus marketable securities divided by current liabilities. For clear understanding, we will work out few sums in liquidity ratio. Here, the list of current assets and current liabilities are given. So, we want to calculate current ratio, liquidity ratio, and absolute liquidity ratio. In that list, cash is a current asset, debtors is a current asset, closing stock is a current assets. There are three items in the list of current assets. The next bills payable is a current liability, creditors is a current liability, outstanding expenses is a current liability, and tax payable is a current liability. So there are four items are listed under the current liability. So formula for the current ratio is current assets divided by current liabilities. So there are three items in the current asset: cash, debtors, closing stock. The total of current asset is 3,40,000. Then bills payable, creditors, outstanding expenses, tax payable, all are under the current liabilities. So the total amount is 1,67,000. So next we want to apply the formula current assets divided by current liabilities, that is 3,40,000 divided by 1,67,000. So the current ratio is 2.036 times. Second one is liquid ratio. It is also known as quick ratio and acid test ratio. So the formula for the liquid ratio is liquid assets divided by current liabilities. So here liquid assets means current assets minus stock and prepaid expenses. So the value of current asset is 3,40,000 minus stock amount is 1,80,000. And there is no prepaid expenses. So current asset minus stock is a liquid assets. Current asset is 3,40,000 minus stock value is 1,80,000. So the liquid asset is 1,60,000. So next we will apply the formula. Liquid ratio is equal to liquid assets, that is 1,60,000 divided by current liabilities. The same amount used in the current ratio, that is 1,67,000. So the liquid ratio is 0.96. Next, third one is we want to calculate the absolute liquidity ratio. The formula for the absolute liquidity ratio is cash and bank balance plus marketable securities divided by current liabilities. So here cash and bank balances and marketable securities, only 18,000 is there. So 18,000 divided by current liability, the same amount used in the above formulas, 1,67,000. So the answer is 0.11. Next, second sum is, here the list of current assets are given and a list of current liabilities also given. So sundry debtors, cash in hand, cash at bank, trade, investment, bills receivable, prepaid expenses, closing stock, all are under the current assets. Then next, sundry creditors, bills payable, outstanding expenses, all are under the current liabilities. The sum itself, current assets and current liabilities are given. Next, we are going to apply the amount in the formula. Current assets is equal to current assets divided by current liability. So current assets, total current asset value is 2,90,000. So total current liability value is 72,500. So 2,90,000 divided by 72,500. So the current ratio is 4 times. Next, acid test ratio or quick ratio. The formula is same, liquid assets divided by current liabilities. Here, the liquid asset means current asset minus stock and prepaid expenses. Here, stock amount is given and prepaid expenses also given. Stock amount is 80,000, prepaid expenses amount is 10,000. So 2,90,000 minus 80,000 minus 10,000, that is stock and prepaid amount. Minus means the liquid asset value is rupees 2 lakh. So now 2 lakh divided by 72,500, that is acid test ratio is 2.76 times. Next, third one is absolute liquidity ratio or cash position ratio, are also known as super quick ratio. So here we want to add cash, bank balance and marketable securities. So cash in hand is 40,000, cash at bank is 60,000, then trade investment is 20,000. That is, trade investment is also known as marketable securities. So divided by current liabilities, the same amount used in the above formula, 72,500. So total 1,20,000 divided by 72,500. The answer is 1.66 times. Next sum is the balance sheet is given. So list of assets are given and a list of liabilities also given. So we want to find out the current assets in the balance sheet, and also we want to find out the current liabilities in the balance sheet. So asset side, in the asset side, there are 5 items are there. First one is land and building. Second one is plant and machinery. Third one is stock. Fourth one is debtors. And fifth one is cash at bank. Here, the first 2 items are fixed assets. Land and building and plant and machinery is a fixed asset. So, it is not coming under the heading of current assets. So, next item is stock. It is current asset. Then fourth item is debtors. It is also current asset. Then fifth item is cash at bank. It is also current assets. So the total 29,60,000 plus 14,20,000 plus 6,20,000. So the current asset value is 50 lakhs. Then under the liability side, issued capital, it is long-term reserve. It is not coming under the current liabilities. Profit and loss account also not coming under the current liabilities list. 6% debentures are also not coming under the current liabilities list. So only 1 items are coming under the current liability list, that is creditors. Amount is 26 lakhs. So current asset value is 50 lakhs divided by current liability amount is 26 lakhs. So the current ratio is 1,91.92 times. Then second one is quick ratio. The formula for the quick ratio is quick assets divided by current liabilities. So adjustment are given. Quick assets are current assets other than stock and prepaid expenses. Here we want to find out the quick assets. So in the list, stock is there. So we want to minus the stock 29,60,000. So we want to take only 2 items in the asset side, that is debtors and the cash at banks. So stock and the prepaid and expenses we won't taken. So here we have to take only 2 items, that is debtors and the cash at bank, or otherwise we have to take current asset minus stock and prepaid expenses, that is 50 lakhs minus 29,60,000, that is stock. So quick asset value is 20,40,000 divided by current liability is 26 lakhs. So the quick ratio answer is 0.78. Simply, a liquidity ratio is used to determine a company's ability to pay its short-term debt obligations. The 3 main liquidity ratios are the current ratio, quick ratio, and the cash ratio. When analyzing a company, investors and creditors want to see a company with liquidity ratios above 1. A company with healthy liquidity ratio is more likely to be approved for credit. Thank you.